Hi. Let's learn about forward dividend yields and how they can impact investment decisions. A forward dividend yield is an estimation of a year's dividend expressed as a percentage of the current stock price. The year's projected dividend is measured by taking a stock's most recent actual dividend payment and annualizing it. The forward dividend yield is calculated by dividing a year's worth of future dividend payments by a stock's current share price. For example, if a company pays a Q1 dividend of 25 cents and you assume the company's dividend will be consistent, the firm will be expected to pay $1 in dividends over the course of the year. If the stock price is $10, the forward dividend yield is 10%, 1/10, x 100. The opposite of a forward dividend yield is a trailing dividend yield, which shows a company's actual dividend payments relative to its share price over the previous 12 months. When future dividend payments are not predictable, the trailing dividend yield can be one way to measure value. When future dividend payments are predictable or have been announced, the forward dividend yield is a more accurate tool. An additional form of dividend yield is the indicated yield or the dividend yield that one share of stock would return, based on its current indicated dividend. To calculate indicated yield, multiply the most recent dividend issued by the number of annual dividend payments. Divide the product by the most current share price. A company's board of directors determines the dividend policy of the company. In general, more mature and established companies issue dividends, while younger, rapidly growing firms often choose to put any excess profits back into the company for research, development, and expansion purposes. Common types of dividend policies include the stable dividend policy, in which the company issues dividends when earnings are up or down. With constant dividends, investors experience the full volatility of company earnings. Finally, with a residual dividend policy, a company pays out any earnings after it pays for its own capital expenditures and working capital needs. Generally, a dividend yield between 2% and 6% is considered a good dividend yield. Yields above 6% are considered to be higher-risk stocks, which, depending on the investor's risk tolerance, may be a risky investment not worth exploring. Here are 3 key takeaways. 1. A forward dividend yield is the percentage of a company's current stock price that it expects to pay out as dividends over a certain time period, generally 12 months. 2. Forward dividend yields are generally used in circumstances where the yield is predictable based on past instances. 3. If not, trailing yields, which indicate the same value over the previous 12 months, are used. Hope this would help. Thanks for watching.